Welcome to Mind Your Money. I'm Allie Canal, and this is Yahoo Finance's flagship personal finance show. Think of this as your financial toolbox. For the next 30 minutes, we'll give you the latest money news, cut through the jargon, and tap into expert advice, all designed to help you take control and build a stronger, healthier financial future. On today's show, we find out what Americans' finances look like in a new Yahoo Finance Marist poll. And gold prices have been trading near record highs. We'll break down the steps you can take to invest in the shiny metal. Plus, it's another edition of Ask Yahoo Finance Anything. We'll be joined by the debt-free guys who will answer all of your savings questions. 1 in 3 Americans say their financial situation has gotten worse over the past year. That's according to a new Yahoo Finance Marist poll. We're breaking down some of the survey's key findings. Yahoo Finance personal finance editor Casey Bond joins me now. So Casey, this is a very comprehensive breakdown. Let's start with how Americans are feeling about their finances. What else stood out to you in this survey?
Sure. Well, our survey results really show a country that is divided when it comes to their financial health and knowledge. At a high level, we found that younger generations, particularly Gen Z, tend to be more optimistic about their current financial standing and ability to save. On the other hand, women tend to be a lot less positive about their finances than men. And we also found that lower income households, generally around under 50K a year, are actually less likely to turn to debt to manage their budgets better versus higher earners.
That's interesting. Now let's zero in on savings. How are Americans feeling about that financial cushion?
Right. So, again, the results were pretty divided. About a quarter of our respondents said that they were very or completely satisfied with their savings over the last year. However, again, men were much more likely than women to say that they were satisfied with their savings progress. And it might seem like, women are maybe not as good at saving money, or, men are inherently better at saving money. But we had one of our reporters actually dig into this a little bit more to find out why this gap exists. And one of the reporters that she spoke to said that there are some financial challenges that are unique to women. For example, they're still paid less than men on average. And there's also this cultural expectation for women to leave the workforce or take lower paying, more flexible jobs in order to provide caregiving within the household. So that kind of gives a little bit more context to some of these results.
And for those that are worried about their savings, how are they planning to deal with a potential cash flow shortfall?
Sure. So when you're in a situation where your expenses are exceeding your income, there are several steps you can take, from dipping into your savings to maybe taking out a personal loan. We found that about 40% of our respondents would actually cut their spending first, which is a little bit surprising given today's economic environment and how inflated prices are. And particularly households earning under 50K, again, are the ones who are most likely to say that they would cut their spending first. Another 26% said that they would dip into their savings. 23% said that they would use a credit card. And then just 10% said that they would borrow money in some other capacity.
Thanks, Casey. And you can scan the QR code below to get more insights from our Yahoo Finance Marist poll. More investors are turning to gold as a way to diversify their portfolios in today's uncertain financial environment. So let's break down what you need to know before investing in the precious metal. Step 1, set your goal. Gold tends to hold its value and sometimes even rise when other assets are falling. So many investors use it as a stabilizer. Typical goals include diversification and protecting your purchasing power from inflation. Step number 2, decide your allocation. That's how much of your portfolio you want in gold to manage risk over the long term. Gold has long up cycles and down cycles. In down cycles, it can drag on returns, so you might keep your allocation lower if that's a big concern. But if you're willing to sit through the weaker years, a higher percentage could pay off more in the strong ones. Step number 3, choose your form of gold. So there's a physical gold that includes jewelry, bars, coins. They offer peace of mind, but comes with that theft risk and less liquidity. Then there's something called gold mining stocks. More liquid, but also more volatile. Gold ETFs are funds that invest in gold mining stocks or physical gold, and while they do offer more liquidity, they can also come with fees. And finally, gold futures, contracts to buy gold later at a set price. They offer leverage and convenience, but also carry higher risk and complexity. And step number 4, consider your timeline. Because gold prices can swing, it's not ideal if you need the money in the short term. An extended holding period gives you a better chance of meeting your goals. And if you want to dig deeper into how to invest in gold, just scan the QR code on your screen. Well, Social Security is officially 90 years old. The program was signed into law by President Franklin Roosevelt in 1935 during the Great Depression, designed to provide economic security for older workers, people with disabilities, and those who've just lost their job. This anniversary is also a good reminder of a few key deadlines coming up. First, the Social Security Administration is going paperless on September 30th. That means no more paper checks for benefit payments, so be sure that you and your loved ones are enrolled in direct deposit or have a direct express card. Second, in October, we'll get the announcement for the 2026 cost of living adjustment. A new estimate from the advocacy group Senior Citizens League puts that increase at 2.7%. And to mark 90 years of Social Security, we're busting a few myths about the program. Joining me now is Yahoo Finance senior columnist Carrie Hannon. So Carrie, let's start with the biggest fear around Social Security that has been spreading for years, and that's that the program is running out of money. Is this true?
No. So thanks, Allie. Yes, there is an issue here. Social Security is funded by payroll taxes and interest from bonds, right? And there has been a gap between since 2021. There has been a gap in as much that can pay for the benefits going out. And so as a result, that's been made up from taking money from what is called the trust fund. And the trust fund is scheduled to be depleted, projected to be depleted in 2033. So there will be a gap. It is not going to run out of money, but at that time, it will only have enough to pay out from the payroll taxes and the interest, which is 77% of the current benefits. So that is a huge cut. But most of the experts I have spoken to do not believe that Congress will ever let that large of a cut actually come to be. So it is not going to be run out of money, but there is definitely the threat of a lower benefit if something does not get done.
Okay, so we busted myth number 1. Let's go to myth number 2. Aging baby boomers are a problem for Social Security's future. What do you say to that, Carrie?
Yeah, again, absolutely not. This has been planned for decades. They have known that there was going to be an aging population. Yes, in fact, there are fewer younger workers. There has been a decline in the birth rate, which was anticipated. And so there are fewer people paying into the system. That does create an issue, Allie. But the real problem is that there's been income inequality. And so as more people earn more than is the cap for what gets charged, what gets levied a Social Security tax on, which is $176,100. People who earn above that, any above that, you do not get taxed for your Social Security, your FICA tax, it's known as. So as more people earn above that amount, they're not getting the extra income from people's their income as one might expect they are. So that is more of the issue here. It's not people getting older. It may just be that they're making more money.
All right, and lastly, some believe that Social Security benefits drive the U.S. deficit. Is that the case?
Yeah, here's what happens. No, it does not at all. Social Security is funded from what we talked about, those payroll taxes. It's called FICA taxes, which come to 12.4%. And that's split evenly between an employer pays half of that and the worker pays half of that. So it is completely funded by that and the interest payments from the bonds that's invested in. So the Social Security never takes money from the federal government to pay for the Social Security benefits. So in no way does it contribute to the deficit.
Carrie, thank you so much for busting those myths for us. Appreciate it.
Sure.
Well, coming up, a special type of home loan for veterans. We break down what a VA loan is, how to qualify, and how to get the best loan possible. Stay tuned. Military service in the U.S. comes with an exclusive benefit designed to foster home ownership, the VA loan. A VA loan is unlike any other mortgage on the market. They're offered through a range of lenders like banks and credit unions, but administered by the Department of Veteran Affairs, which guarantees part of the loan. Some of the biggest benefits include no down payment, no loan limit, and lower closing costs. Plus, no private mortgage insurance and the option to purchase a home and finance repairs that are completed after closing. VA loan interest rates are often lower than conventional mortgages, though they can still depend on creditworthiness and overall finances. Joining me now to discuss is veteran and former Pennsylvania Congressman Patrick Murphy. Patrick is also co-host of Yahoo Finance's Warrior Money video podcast. So Patrick, you served in both the military and Congress. Can you explain why VA loans are so important to both veterans and service members?
Yeah, listen, VA home loans are a game changer, really the access to middle class. Taking a step back, the number one wealth tool for all Americans is really your home, right? It's the biggest wealth generator. But in the military, the fact that it's the two things, it's the VA home loan and the GI Bill. But on the VA home loan, the fact that you could go buy a home with no money down, that the VA is going to say, listen, I back you, Allie, or I back you, Patrick, right? And saying, because they're going to be creditworthy, they have a job, et cetera. So it changed my life when I left the military. My first home was a VA home loan. And, for others, if it's the average home is like $300,000, right? Most folks don't have 60 grand to put down when you're serving in the military, right? When you're in that public service. So to be able to do that without that 20% down is a game changer.
And how can this help veterans not only purchase a home, but really build their wealth through home ownership like you were just talking about?
Yeah, no, this is what I get so excited about. So, we have this Warrior Money podcast. We tell our brothers and sister veterans and service members how they could have side gigs. And this is one of the biggest ways to become an entrepreneur. How do you do that? Okay. You might live in the barracks, you might live off post, right? And you get basically housing allowance, et cetera. But if you go get a VA home loan, you can go and get another property and you can go and either Airbnb it, you can go and rent it out to other folks, or you could just flip it in a couple of years, put time into it. So a lot of folks really have these side gigs around utilizing the VA home loan, and it's been a game changer for my brother and sister troops and veterans.
And you teach entrepreneurship, right, to a lot of these vets. What's the big lesson that you see them take away, or what's the biggest question that they have in coming to you and really trying to figure out where to start?
Yeah, I think part of it is it can be overwhelming, right? So Allie, what we try, my co-host Dan Coons and I, what we try and tell folks is listen, if you see it, you can be it. So, I teach this to the business students at Wharton, when I teach, and it is, have confidence and bet on yourself. Your network is your net worth. So, using that network of the military, those opportunities like the VA home loan, like the GI Bill, to better yourself, better your assets, and better your financial readiness.
I love that. Your network is your net worth. That is so true. What about the challenges that maybe some veterans could face when trying to acquire some of these loans?
Yeah, listen, you don't want to get too far out of your skis, right? But that's why you should, watch our podcasts, read books, et cetera. And, I'm kind of leery of going into debt, except if it's good debt, except if it is, you're going to invest in yourself for college, or if you're going to invest in a home that you turn around and either utilize it or frankly use it for other folks. So for me, the greatest, I've been very blessed as a blue collar kid in a row house in Philadelphia to be able to, leave public service, that buy a home for the VA home loan, to go buy another home and be able to basically increase my net worth. It's really been a game changer for the Murphy family, and has set my son and daughter up for great success.
I'm wearing my Philly Eagles green in
go.
solidarity.
Go Birds!
Go Birds! Thank you so much. Appreciate it.
Thanks, Allie.
And you can catch more of Patrick Murphy on Warrior Money every Monday wherever you get your podcasts. Lenders issued more than 416,000 VA-backed loans in fiscal year 2024, with the average loan amount coming in at just over $373,000. That's according to the VA. Here to talk about how veterans can secure the best VA loan is Vanessa Alanis, a certified financial planner at Black Dog Wealth. Vanessa and her spouse recently went through the VA loan process themselves. So Vanessa, let's start there. What was that experience like, and what surprised you most along the way?
Thank you so much for having me. It was actually very smooth, I have to say. The process was handled well we had a lender that was familiar with the VA home loan process. So pretty nice. And owning our own home after so many years of service was a definite treat.
So for veterans or service members just starting out, what's that very first step they need to take when applying for a VA loan?
The very first step, a veteran, and again, you don't have to be a veteran. You can still be an active duty service member to use this benefit. But the very first thing they'd want to do is get a certificate of eligibility from the VA. They can get this certificate either by going online or by having their potential mortgage lender apply for it that way. Or since it's the government, we can still do it by the mail as well. But that would be the first step to make sure that they are eligible and to get that certificate of eligibility.
So you mentioned that certificate of eligibility. How does someone get that, and what else will lenders still want to see in terms of credit and finances?
Again, the certificate of eligibility comes from the VA, so they will use the VA to get the certificate from. Applying for a VA home loan is the same as applying for a regular home loan, so all of the other things will still matter. A veteran would want to make sure that their credit is in order, have their personal finances in order. They're going to want to make sure they understand how much they can afford and look at their numbers before starting the loan approval process, because they want to make sure that the mortgage loan provider is not going to make sure that they're providing a loan that the person can pay for. They're going to want to make sure they can do that themselves. I see here that, to qualify for a VA loan, again, it doesn't have to be a veteran, it can be an active duty service member, and in certain situations, qualifying surviving spouses.
And what great thing about VA funds is that there's usually no down payment, but that doesn't mean that there are no fees. So a VA funding fee is something unique to veterans. How does it work, and how should vets navigate this?
So you're correct. There is no down payment for a VA home loan, but the VA does try to recoup the expenses of running this program to taxpayers by having a funding fee. And a funding fee is a percentage of the mortgage, and this percentage ranges depending on whether or not it's the first or subsequent use of this benefit and if there is a down payment involved. And again, a down payment is not required, but a service member can come to the table with one. The fee ranges anywhere from 0 to about 3.5% of the loan value, and it can be financed. But this is definitely something for a service member to have be planning for as they're preparing to purchase a home.
Mm-hmm. And is a VA loan a one-time benefit? Are there other restrictions on property types for this type of loan?
No, a benefit can be used more than once. So a property restriction is that it has to be for a primary residence. So a service member has to be planning on living in this house initially. But per your previous guest, if they should move and decide to rent it out, they can still use some remaining benefit to purchase another home. They would want to get a new certificate of eligibility before engaging in the home loan process for a second home to make sure that they know how much benefit is available for them. But yes, they can use it more than once. So it really can help people increase their wealth.
And any lender can choose to work with the VA. So how should veterans shop around for the best rates, the best terms? And is this search any different from someone who isn't a veteran?
It's not too different, except you do want to make sure that your lender is familiar with the VA home loan process, because there are a couple extra documents that are and processes that are involved, such as having a VA home appraiser and the escape clause, so to speak, if your home should not appraise for the correct value. But other than that, you're going to want to shop around the same way: who offers the best interest rates, who has the best customer service, those kinds of things. And an interesting fact that just because a bank may be very familiar within the military community does not necessarily mean they are providing the best rates or customer service. So I do encourage people to shop around to at least 3 different vendors if they are looking at getting a home loan.
And I'm curious, are there specific VA lenders?
There are mortgage providers who tout themselves as being VA lenders, but that just means that they choose to accept VA-backed loans. The VA does not sponsor individual lenders.
Okay. And how can veterans think strategically about using a VA loan, whether that's refinancing later, buying again after a move, or building some of that long-term wealth that you were just referencing through home ownership?
Well, I think it's important that veterans look at their whole financial picture when trying to utilize a product like this and understand how this fits into their total goals. Preferably using a financial professional to help them along with this. But it can help them secure housing at their different duty stations And it can be used to build an investment property portfolio if done in the right way. So I just encourage them to look at their total financial picture and what their family's goals are.
And Vanessa, thank you so much for your insights. And you can scan the QR code below to get more information about VA loans. It's time for our weekly segment, Ask Yahoo Finance Anything. And this week, we're focusing on emergency savings and investing advice. Joining me now are John and David Ottenschneider, the debt-free guys and hosts of the podcast Living Not So Fabulously. Welcome, guys. Let's jump right in with the first question. Is it better to pay off debt or save for an emergency fund first? David, let's start with you. What do you think?
Definitely. I think that, as with most financial questions, it depends. I think one of the important things to remember is whether you're paying off debt or you're funding your emergency savings, both are working in the positive direction. They're both improving your net worth. But we encourage people to look at a dual approach. First, build emergency savings enough to cover your major deductibles for things like car insurance or home insurance. Then work on paying off that credit card debt. While you're building your emergency savings, though, make sure that you're making those minimum payments on those credit cards.
And second question, someone asks, how much money should I keep in an emergency fund? John, you can take this one.
Well, that's a great question to ask. Vanguard recently came out with a study that showed that respondents said that if they had $2,000 in an emergency savings account, their financial anxiety decreased by 21%. So maybe that is something to strive for. We have always said shoot for having a minimum of at least $1,000. And keep in mind that if you have contributions into a Roth IRA, you can withdraw those contributions without penalty or taxes. So that could always be your emergency savings account on top of your emergency savings account. And maybe contribute enough to an emergency savings account and to your Roth to be able to use a dual approach, as David said.
And question number 3 is about investing. The viewer asks, how can I invest for retirement if I don't have a 401k at work? David, what's your advice for them?
You know, this is a really common question because there are a lot of individuals working for small companies that can't afford to fund a 401k. So the best approach is to look towards your traditional or Roth IRAs. Obviously, Roth IRAs, there's some income limits on those. But the nice thing is you can contribute up to $7,000 if you're under the age of 50. If you're 50 or older, you can contribute $8,000. And if you have a side gig, you're able to set up a solo 401k. And if that's doing really well, you can contribute to that up to $23,000 a year. Or if you're over the age of 50, that's $30,500 a year, which that's a pretty good side gig.
Yeah. And final question here. Should I use a robo-advisor or pick my own investments? John, are you pro-bot or not?
If you're a lazy investor like I am pro-bot. Hire the robots all you can. If you're a more active investor or more engaged investor like David is, maybe not necessarily a robo-advisor is for you. But keep in mind that if you do decide to manage your money on your own, financial advisors and robo-advisors earn their keep, right? It takes a lot of time and effort to be able to find the right stocks or mutual funds and to manage your portfolio. And most fund managers can't beat the stock market 2 years in a row. So if you're not able to up to par with that kind of a competition, maybe hire the robo-advisor, but make sure that they're low cost and that they keep the cost of your investments below 0.5%. And make sure that, of course, that they also invest in a diversified portfolio of low-cost index funds or ETFs.
All right, John and David, thank you so much. You can hear more from the debt-free guys on their podcast, Living Not So Fabulously. That's out every Wednesday at 3 p.m. Eastern on Yahoo Finance or wherever you get your podcast. Well, that's it for Mind Your Money. Scan the QR code below to sign up for the Mind Your Money newsletter. And stay tuned for Market Domination. That's coming up next.